Good afternoon, everyone. So we're going to have a look at some more macro ideas here. Currencies, precious metals. We'll have a little bit of a look at some of the commodities such as crude oil and how we've been viewing this over the past couple of weeks in Merck Method, and those of you that have been with me for a little bit longer than that, how we've been viewing our biases on these assets is pretty much being determined on what the Federal Reserve are doing. So when we look at currencies, the question is pretty much what's driving the bus. And what we've realized was inflation stayed stubbornly high around 1.8 to 2%, while the Federal Reserve completely took a back step on the idea of raising interest rates. And the question is why? If you look at equities, year-over-year rate of change in tax receipts, both of them are exactly the same chart. So the top 1% pay 30% of the taxes, and depending on the equity markets, will determine the income that the government receive. And that income is extremely important in order to pay down the debt that they have. Governments in Western society are massively over-leveraged. And so what you're going to see is every time the S&P 500 moves, that's what's going to determine Fed policy. So right now, as I said a moment ago, interest is trending between 1.8 and 2%, yet we've got the Federal Reserve actually talking very dovishly. And I believe that might actually increase a little bit further now that we're getting closer to a top in the S&P 500, and we'll have a look at that in a moment. I'm not going to go into the details of each asset class, but what we are going to look at the Fed rate probabilities. You guys have all of this in the course. So for May, this is in 6 days and 11 hours, 97.9% chance that nothing happens, right? We stay exactly the same. So nothing's going to happen. Once the probability is above 60% in one direction or the other, that's what the Fed does. So for the next meeting, nothing's going to happen. Don't worry about whether we're going to get a rate hike or rate cut. The narrative or the rhetoric that comes from the Federal Reserve is more important. What I'm interested in is what happens in December. And what you can see in December is here, above 60%, we fully discounted one rate hike. And this is sort of fluctuating between a rate hike and staying flat. As of right now, we've got more than 60% chance it's going to be a rate cut. That's going to affect the currency massively. And as you guys know from the data in the course, inflation is set to roll over later this year. So as inflation falls, and that could be the transitory effects of asset prices that we've already seen in crude oil, etc. And the reason that could be the case is because inflation is a year-over-year metric. It's massively lagging by 12 months. So when something happens today that's highly sensitive to inflation, like crude oil dropping, we don't see that for 6 to 8 to 12 months into the future. And when we eventually see it, it's too late. And the Fed are reacting on actions that happened a long time prior to that. So that's essentially what we're forecasting, is inflation's to trend between 1.8 to 2% into the end of the year, and then it's to drop massively. So I'm very focused on the December rate decision, and right now it's saying that we're going to cut interest rates greater than 60%. So that's what we need to focus on later this year, full capitulation from the Fed, and that's when you get short the dollar. So now let's have a look at the dollar itself, and what should we expect? As you guys know, we've been looking at the DXY, we've been expecting a breakout, and we got that breakout. This was a triangle, wave 1, 2, we're looking for some sort of ending diagonal, and so far that's playing out perfectly. The reason I say so far it's playing out perfectly, let's make the screen a little bit bigger. If we zoom in here, you can see this wave 1 is 1, 2, 3 waves up, right? Ending diagonal is 3, 3, 3, 3, and 3. It's a little bit messy on the lower time frame. So as you can see, 3 waves down for a wave 2. So far we've got 3 waves up for a wave 3. We should expect some sort of pullback back into support here in 3 waves, and then 3 more waves up for a wave 5. We're looking at that target of 98.64. That is the minimum target we're looking for. It's not going to be a case where we just sell it at that point. That's the minimum area that we're looking for. And once we get there, we can assess whether a full pattern is completed for a wave 5, and we start to move lower from there. It's probably going to correlate with the rhetoric from the Federal Reserve, and then ultimately we get that discounted rate hike into December. What the rate hike probability tells us in December is what are the chances of the Fed continuing to stay dovish and ultimately acting on it in the future, and that's what we should be focusing on, because the market will discount that today for something that's going to happen in the future. That's very important. So always remember that the market is a future discounting mechanism. It's going to discount today what it expects in the future, And if we expect some sort of rate cut in December and the whole market knows about it, why would they not start shorting the dollar today in anticipation for that? So that's what essentially happens in markets. So what we'll probably have is a breakout here, false breakout, and we move back down. So the dollar is moving largely as expected. Now let's have a look at the euro dollar. And again, moving largely as expected. This is an ending diagonal perfectly. We got that rally back up, but we knew that this had to break down in 3 waves. Remember, 1, 2, 3 for a wave 1, the same as the DXY. 1, 2, 3 for a wave 2, 1, 2, 3 for a wave 3, 1, 2, 3 for a wave 4, and then 1, 2, 3 for a wave 5. Wave 1 here would be equal to wave 5 on the downside, and that's why we have it marked off at somewhere around 111. Again, that's not an area we just jump in and buy it because that's where our target is. That's where we should look for some sort of reversal. The bottoming patterns are a process. It takes a little bit of time in order to bottom out. A topping pattern is usually an event. Now in this case it was actually a process, but typically you see a topping pattern as an event. It literally goes up and then it comes straight back down. So don't worry about not getting the absolute low, just worry about getting a high probability position in a good area when we're looking at currencies. These are clearly not as ready as we seen yesterday with National Beverage Corporation. So do take your time. We're not in a rush. We just need to make sure that we're making money. At the end of the day, it doesn't matter what my performance is, it doesn't matter what your performance is. All that matters is when you go to the bank machine and you stick your card in the machine, how much money does it show? That's all we should care about. Stop focusing on anybody else, start focusing on making money. And making money doesn't mean that you need an ego to say I caught the absolute low. It just means that you need to get in a good area. So for right now, guys, our target is still 111. I've no reason to suggest that it's not going to stop here. I do think there's further downside before we start turning higher. Another chart that's playing out perfectly is the Australian dollar. So we were expecting this WXY to play out with the potential of getting as high as 0.722, and that could be a shorting opportunity. As you can see here from the 200-day moving average, it couldn't get above it. It failed to get above it and then it collapsed from there. Still think there's more downside to be had here. I think this wave Y should be equal to wave W, and that's where the B wave will complete off. So I'm still waiting for, I'll delete this off here, still waiting for a move lower to 0.69309 before we can get long for that next move higher. So everything is moving to plan. However, we just need to be a little bit patient and make sure that we're buying in the right areas. Don't rush any decisions. The opportunities will come all the time, and if you're diving into something trying to front run some sort of move, it's going to backfire on you. Just have patience, and I guarantee you your performance will go through the roof when you wait for these areas instead of diving in. There's still more downside to be had here in the Australian dollar. Now we started off with the dollar because I do think the dollar might have a little bit more upside to go, and if the dollar has a little bit more upside to go, it's going to weigh heavily on gold and silver. Now that doesn't necessarily mean that gold and silver can't move higher. They're correlated, inversely correlated, but not perfectly inversely correlated. And what I mean by that is there is periods where the dollar will actually rise and so will gold and silver, and we've seen that last year. So right now this is really interesting because in last weekend's update I suggested that maybe this could be a W, X, and a Y, and that would give us a target in and around 1266. Now, how do we get that? If you guys go and look at the course and look at charting, you guys will see that a wave A and a wave C are usually of equal proportion, right? So 3.35% down here for wave A and almost 3.35% down here for a wave C, 1 to 1. That would be 3 waves down for a W, 3 waves up for an X, 3 waves down for a Y. Now, it's really not going to be confirmed until we break above this 1310 area. Once we break above that 1310 area, the low is 100% in. I'm almost certain of that, because the pattern would now suggest that we're pushing higher. The only question would be is whether it's going to be 3 waves up for a B and there's going to be a deeper pullback. However, I'm not too worried about that right now because I do think the dollar is coming closer to an end, and maybe gold and silver are starting to recognize that. So this looks like a very good area to consider gold. As you guys know, I do have a small position in silver, and I'm looking to add to that position. So the position of choice for me is silver, not gold. So we have a look at silver. This is a beautiful pattern. This is a really, really beautiful pattern. 5 waves up for a wave 1, ABC down for a wave A, ABC up for a wave B, and then an ending diagonal A, B, C, D, E for a wave C of wave 2. These patterns are very bullish. Look where that came, 61.8% Fibonacci. This could not play out any more perfect. We've been looking for that for some time. Now, as you guys know, I'm in from over here around 15.2. I'm not sure the exact amount that I'm in on this silver CFD because I own SLV, but it was in and around this rally here. So I'm slightly underwater on the position, but it doesn't really bother me because my position size and my risk and my expectation were all in line. I was fully expecting we move back down to the 61.8 if I was wrong here, and that's what's happened so far. If this is right, this should explode higher very soon, and maybe it's going to go a little bit sideways here, come back down, back test into the FOMC meeting in 6 days time on the 1st of May, and then it explodes higher. That's potentially what may happen, but this is a full complete pattern. What I'm looking for now is on the 4-hour chart, the 200-day moving average. I'm expecting a break above there. This has been quite consistent. It's starting to flatten out, and once it starts to curl higher, lower time frames will start to suggest that the trend is moving to the upside now. So as you can see, we topped out in the trend here, and when it turns lower, the trend is lower until it's not. We now have information that potentially the stock market is slightly overvalued. And you can look across the board at the earnings from yesterday. Although Facebook burst higher, you got to look at Facebook's margins. The operating margin's gone from 41% down to 22%. Yes, they beat on revenue, but the actual net profit that the company made was lower because they had to protect customers' data, and it cost an awful lot more money. Also, when you look at the staff, their staff has grown by 38% year over year. So massive overheads had at Facebook, even though the stock went up 7%. Question is, what happens on the open, and will it last? But these numbers are suggesting that obviously things are not all that they seem. We could also say the same about Tesla. So Tesla's earnings, they're expecting a net loss, earnings per share of 69 cents. It came in at 290. And they burnt on average $10 million cash burn per day, every single day for the last quarter. So these numbers are not good. They're not good. And maybe the market has overestimated earnings, and this is where we start to see some sort of rotation. So I do think buying staples, utilities, etc. in and around here, anything that's on a discount is probably a good idea. Bit of a rotation out of growth and high potential companies into more consistent businesses. While that happens though, because the market caps are very different, the S&P 500 will go sideways to drop for the wave 2 correction. Now as the S&P 500 pulls back, the Federal Reserve will start to talk more dovishly, and of course that's going to affect the dollar, and that's going to affect gold and silver and push it higher. So in a very long-winded manner, I do expect this to break higher. What I'm focusing on to add to my position, however, is a break above this 4-hour 200 MA. Once we get above there, I will double down on my position, and the expectation would be that this starts to move up towards, up around $19 from here. So there's massive upside, about 30% upside if this starts to take off here. So I do think, guys, that silver is a great opportunity, and although I like it here, I already have a position and I'm not ready to add just yet because I want a little bit more increased probability before I consider adding to any of my positions. Next, let's move on and have a look at the S&P 500. So the S&P 500 is hit right up against our target. The target, how we measured that target was very simple. Wave 1 would be equal to wave 5. We hit it right away, and it hit it like a brick wall. It couldn't get through it right away. However, I wouldn't be surprised if we broke slightly higher before we moved lower. The simple reason being is we need to see 5 waves up for the final 5th wave of 5. So far we've only got a wave 1, 2, 3, 4, and this would be the 5th wave pushing higher here. So we might see one more push higher here before we start to roll over, and that would be the ultimate top. I think in and around here, if you wanted to protect your portfolio, you could start to take small short positions in the S&P 500. You could start to hedge your risk by either buying puts, selling calls, or taking a short position in your portfolio in order to protect the long exposure that you might have. The target on this, as I've mentioned, it could go as low as 25.66. However, there is strong support in and around this 26.26 level. What I would say is, if you're going to put a small position on this next little pop here, make sure that you've measured your risk effectively, and as it starts to break down, we can worry about potential targets in that moment. 2600 would be the first area that I would be looking at potentially reducing exposure on the short side, because all the data suggests that we should continue pushing higher. So the S&P 500, guys, this came right up into our target perfectly, and now it's starting to consolidate sideways. One more slight push higher up to new all-time highs, and then we should start to roll over from there. Very similar to the S&P 500, you have crude oil here, and crude oil, it may have already topped, or we might want to see one more slight higher high, but as you can see, these ratios are perfect. 28.99, 28.99, hit it perfectly, may go slightly higher, but ultimately a top should be in here close. To everybody that thinks that Elliott Wave is voodoo magic, I see this happening far too often for me to just brush it aside and conform with everybody else. Elliott Wave, as long as you've got a strong fundamental backdrop in your expectations, is highly effective. Highly effective. It takes a while to get used to it, absolutely, but I see this happen all the time. Forecasting markets isn't that difficult. So let's recap on our view of crude oil. So what's been happening over here, the reason it was a very easy long position was because we recognized that the supply of crude oil was really outpacing the demand, and so there was a supply glut. Demand was still trending at 1.5%, yet supply was continuing to grow. So as that supply was growing, it was causing the price to collapse. Down here, this is when OPEC came out and said they're going to start production cuts. That would perfectly fix the market if there was production cuts from OPEC, because it would start to address the issues of the supply shock that we'd seen. And that's essentially what happened. The market started to discount it, and so far it continues to discount it on the upside. I unfortunately got out of my position a little bit too early. However, I still made a profit. I'll never ever be disappointed about that. The main thing is, once you get out of the position and you feel that it's fair value, you can't chase it higher. Isaac Newton closed his position during the South China bubble and ultimately bought back in at the top, and he died broke, right? So we don't want to do that. We don't want to chase the market sentiments. We want to buy it at the bottom when no one else wants it, and we want to sell it at the top when everybody else wants it. We want to sell to people like Isaac Newton who don't have the discipline to sit back. And that's essentially what happened here. I felt this was a top in and around this area. Ultimately, it continued to trade higher. And look, I made a profit. I didn't realize as much of a profit as I fully expected. However, lesson learned. Again, it always comes back to holding the position longer term. Time horizon is so important. It really is so important. You can make or break your entire year based on your time horizon. If your time horizon is too short, you get out too early, you don't materialize enough returns. And that's essentially what I done here. The entire production cut from Venezuela is all but in the price. And if any information comes out that OPEC have not been compliant and you're starting to see a supply increase again, the price is going to drop. It's a future discounting mechanism. And I don't know how Venezuela can go lower than where they are right now in terms of production. They're pretty much at zero. I think it's about 100,000 barrels a day or less that they're doing. And that's from over 1 million, I believe, about a decade ago. So Venezuela itself, I think that story is completely in the price. It's already in the price. Is the Iran story going to pick up again? I don't think so. And as well as that, we got to look at Saudi Arabia and Russia, and both of them have government policies pegged at around $60 to $65 a crude oil. So we're at 65 right now. I think they can increase production, rein in that income, and of course that's going to send the price a little bit lower for a B wave. So to recap everything, because I think there was an awful lot of ideas here, I think the Federal Reserve are going to be dependent on the move in the S&P 500. If the S&P 500 goes lower, the dollar is going to go lower because the Federal Reserve are going to transition. And we've seen that for the past couple of years. It's because of the tax receipts. However, we're not there yet. The dollar has a little bit further to trend higher before it starts to move lower. We have a meeting on the 1st of May, 6 days from now, 6 days and 11 hours, as we've seen from the rate hike monitor tool. 6 days and 11 hours till the next meeting. The rhetoric in that meeting will be very important because it'll give us indication into how the Federal Reserve are feeling about current conditions broadly, or the S&P 500. We are expecting the S&P 500 to correct, so we are expecting a weaker dollar, and that's ultimately going to push up assets such as precious metals, gold and silver, and I think they're going to start pushing higher for two reasons. One, the weaker dollar. You want to own real tangible goods, which would be gold and silver, precious metals. And number two, real yields will drop lower. So it discourages investors from holding paper losses, such as buying bonds with a 2% yield or a 1.5% yield, while inflation is trending at 2%. You're losing 0.5% per year. So you're better off paying the storage costs for your gold, knowing full well that over time it appreciates and it's got tangible value. And then, of course, we've got crude oil. We need to look at OPEC and see what's going to happen with supply. So, guys, that was a long-winded update. If you guys have any questions, please do reach out to me. I don't think any of these are ready yet. I just wanted to get a quick update out before the weekend just to show you how the charts are developing and where we should be looking and the areas we should be looking in order to potentially take a position. If I take a position, I will have another video out just like the one I sent yesterday with National Beverage Corporation. We just need to be patient. We need to stalk our trades. It's not about the volume of trades. It's about the return on those trades. That's all that matters. And if we only make one trade per year, and that's a positive trade, and we make money on that trade, you're doing better than 90% of retail traders. Anyway, guys, I will digress. If you have any questions, please do reach out, and have a wonderful day, everybody. All the very best.